Hello everyone and welcome. I'm excited to have you here today. In this presentation, we'll be exploring topic 5, which is all about consumer behavior and consumer banking. Over the next few slides, we'll delve into how consumers make decisions, what influences their banking choices, and how banks can better understand and serve their customers. Let's get started. Let's talk about consumer behavior, which essentially explains how people decide about buying and using services. It's not just about the act of purchasing, but also about how consumers search for information, how they make their choices, and how they actually use the services they select. Understanding this process involves looking at needs and motivations, what drives people to want a particular service, and what they hope to achieve from it. These factors play a crucial role in shaping their decisions. But of course, the context really matters. Social influences, like friends or family, and situational factors, such as the environment or timing, can significantly impact consumer behavior. For banks, especially, this understanding is vital. It helps them design offers that are truly relevant and appealing to their target audiences. By grasping how consumers think and act, financial institutions can better meet customer needs and foster stronger relationships. So, overall, consumer behavior provides the foundation for understanding how people interact with services, and that's key to developing effective marketing strategies. Now, let's take a closer look at what consumer behavior really involves. Essentially, it's about understanding how individuals decide to allocate their valuable resources, like their time, money, and effort, when it comes to consumption. This could be anything from buying a product to using a service or even disposing of it. It's a process driven by the desire to satisfy specific needs. When we talk about consumer behavior, we're focusing on the actions consumers take throughout their decision-making journey. This includes searching for products, making a purchase, using what they've bought, evaluating their experience, and eventually disposing of or repurchasing. All these steps are driven by their expectations of meeting their needs. This study is crucial because it helps us understand not just what consumers do, but why they do it. It's about uncovering the motivations, preferences, and habits that influence their decisions. By understanding these patterns, businesses can better tailor their offerings and marketing strategies to meet consumer expectations effectively. Overall, this slide highlights that consumer behavior is a fundamental concept that ties into the larger theme of understanding how people make choices in the marketplace. Recognizing these behaviors enables us to create more targeted, satisfying experiences for consumers, which ultimately benefits both the consumer and the business. Let's take a closer look at the practical stages and influences of consumer behavior. First, we have need recognition, which is when a consumer identifies a problem or a goal they want to achieve. This is a crucial starting point because it triggers the entire decision-making process. Next comes the search phase, where consumers gather options and information to address their needs. This can involve researching online, asking friends, or visiting stores. Then we move to evaluation, where consumers compare the benefits and risks of different options. This is where they weigh what matters most to them, such as quality, price, or brand reputation. After making a decision, they proceed to purchase and use the product or service, completing the transaction and experiencing the consumption firsthand. Finally, there's the post-purchase evaluation. This is when consumers assess their satisfaction or dissatisfaction with their choice. Their experience here can influence future decisions and their overall perception of the brand. Understanding these stages helps us see how consumer behavior is a dynamic process influenced by various factors, and recognizing these key points allows us to better tailor our marketing strategies to meet consumer needs at each step. All right, let's talk about customer-oriented segmentation, which is all about understanding who our customers really are. This approach helps us tailor our marketing efforts to meet their specific needs and preferences. First, we have demographic segmentation. This involves looking at factors like age, income, and family size. For example, the products or messages that resonate with young adults might be quite different from those aimed at older, more established families. Next is geographic segmentation. This considers where our customers are located, such as their region, city, or even country. Location can influence preferences, cultural habits, and purchasing behaviors. Then we have psychographic segmentation. This digs deeper into their lifestyle and personality traits. Think about whether someone is adventurous, health-conscious, or tech-savvy. These insights help us craft more personalized messages. Finally, socioeconomic segmentation looks at social class and social status. This can impact buying power and the types of products or services that appeal to different groups. All these segmentation types are about putting ourselves in the shoes of our customers, understanding their world, and then designing our marketing strategies accordingly. This customer-oriented approach ensures we're connecting with the right people in the right way, which ultimately supports the overall goal of building stronger, more meaningful customer relationships. Now, let's explore how geography influences our banking strategies. As you can see, geography plays a crucial role in determining local product needs and the channels we choose to deliver those products. For instance, urban areas have different demands compared to rural regions, which means we need to tailor our offerings accordingly. Additionally, the coverage of branches in a specific area impacts the product mix we promote. More branches can mean a broader range of services, while fewer might require us to focus on core products. Regional campaigns are also essential. They allow us to promote local products that resonate with the community's specific needs. For example, in cities, housing loans tend to be more in demand due to the higher population density and real estate activity. Overall, geographic segmentation helps us better understand where and how to serve our clients most effectively, aligning our product strategies with local needs and preferences. This ensures we stay relevant and competitive across different regions. Let's take a closer look at the key customer segments and how financial institutions tailor their offerings accordingly. First, in areas where the majority of the population is Malay, financial institutions will typically promote Amana Saham Bumiputera loans. This helps to support community development and ensure that financial products are aligned with the needs of the local population. For industrial estates, banks and financial institutions tend to focus more on providing commercial loans. These loans are essential for supporting businesses and industrial growth within those estates. When it comes to housing loans, we observe that demand is generally higher in urban areas compared to rural areas. Urban residents often have more access to employment and income, which makes housing loans more viable and in demand. Conversely, microcredit loans are particularly well demanded in rural areas. These small loans are crucial for individuals or small businesses that might not have access to larger financial services, helping to foster economic activity at the grassroots level. Additionally, it's worth noting that BSN, or Bank Simpanan Nasional, has a widespread branch network throughout Malaysia. Their branches aren't just located in cities, they are also present in towns and remote areas, ensuring broader access to banking services for all segments of the population. Overall, understanding these customer segmentation examples helps us see how financial institutions adapt their strategies to meet the specific needs of different communities and regions, aligning with the broader goal of inclusive financial development. Now let's take a closer look at psychographics, which is all about segmenting customers based on their social class, lifestyle, and personality traits. This approach helps us understand not just who our customers are, but also what motivates their behavior. For example, elderly customers often prefer face-to-face banking because they value personal interaction and trust. On the other hand, young adults tend to favor online investing, which aligns with their tech-savvy and independent nature. Middle-aged individuals usually prefer to invest in real estate, reflecting a more cautious and security-oriented personality. By using psychographic segmentation, we can better tailor our marketing strategies to meet the specific needs and preferences of different customer groups. This approach ultimately enhances customer engagement and improves our overall marketing effectiveness. Life stages reflect changing financial needs over time. As we go through different phases of life, our financial priorities and requirements evolve. This is where life cycle marketing becomes really important. It's based on the idea that consumers at each stage of life will have different buying behaviors, which can actually be influenced by their social class and lifestyle choices. For example, young adults typically need to focus on saving and establishing credit. They might be interested in student loans, starter savings accounts, or credit cards. Moving into family life, the needs shift towards securing a home and protecting loved ones, so mortgages and insurance become essential. Then, as people reach retirement age, their priorities change again. Pensions and wealth protection become key to maintaining their quality of life and ensuring financial security. Understanding these life stages is really useful for long-term product planning. It helps financial service providers tailor their offerings to meet the specific needs of consumers at each stage, making their marketing more relevant and effective. In essence, life stage segmentation allows us to better serve customers by aligning financial products with their current life circumstances, ultimately strengthening relationships and supporting their financial well-being over time. Product-oriented segmentation focuses on the utility that customers are actually seeking. It's about understanding what specific service attributes they value most. By doing this, we can better align our product features directly with their needs. This approach also takes into account Maslow-inspired motivations, meaning it considers the underlying reasons why customers choose certain products or services. Recognizing these motivations helps us design benefit-driven offers that truly resonate with our target audience. Ultimately, by focusing on what benefits our customers are after, we can create more tailored and effective marketing strategies. This approach ensures that our products meet real needs and motivations, making our offerings more compelling and relevant. Maslow explains that our needs and motivations are always changing, depending on where we are in life. His model helps us understand why people are driven by certain needs at specific times. The key idea is that human needs are arranged in a hierarchy, starting with the most basic and moving up to less urgent needs. First, we focus on physiological needs like food, water, and shelter, then safety needs such as security and stability. Once those are met, social needs like belonging and love become important, followed by esteem needs, which relate to respect and self-confidence. This hierarchy is especially useful for understanding why customers choose certain products, because their current needs influence their decisions. It's also a powerful guide for crafting messaging and positioning products effectively. When we consider Maslow's view in relation to financial needs, it reminds us that financial security is fundamental. But as that is fulfilled, our focus shifts towards social recognition and self-fulfillment. So, understanding this hierarchy helps us connect with customers more deeply and tailor our strategies to their evolving needs. When we look at consumer and corporate banking, you'll notice that banks often focus on a specific segment of customers known as ACE customers. These customers share certain key characteristics that make them particularly attractive to financial institutions. Let's break down what makes an ACE customer. First, they are asset-rich, which means they have significant assets or wealth to pay with. This is important because it indicates their capacity to engage in various banking products and services. Second, they are creditworthy, meaning they have a proven willingness and ability to pay back loans and meet financial commitments. This helps banks assess risk and confidently offer credit products. Third, they value exclusivity, which reflects a desire for special services and personalized attention. This aspect is crucial because it guides how banks tailor premium products and exclusive offerings for these clients. Overall, understanding these traits is vital for designing premium banking products that meet the needs of high-value clients. Targeting ACE customers allows banks to build strong, profitable relationships while providing tailored services that align with their expectations. Let's take a closer look at the segment characteristics in banking. Firstly, when banks compete in consumer banking, they tend to focus on customers who have the ability to repay. This is often considered the first key factor. Essentially, finding customers who can comfortably meet their repayment obligations. And on top of that, banks will look for assets that can serve as security. That's the second way out. So if the customer defaults, the bank can recover its funds through these assets. Moving on, the second important point is that the customer must be creditworthy, meaning they have the willingness to pay back the loan or credit. Even for credit card customers, it's not just about having the ability to pay, but also the inclination. Are they motivated and likely to pay on time? Finally, the third characteristic is the desire for exclusivity. A bank product should appeal to customers because it offers something unique or special, like the enriched credit card offered by CIMB and MAS. This sense of exclusiveness makes the product more attractive and helps banks differentiate themselves in a competitive market. So, in summary, these characteristics, ability to repay, creditworthiness, and exclusivity, are crucial for banks to effectively target and serve their consumer customers while aligning with the overall strategy of risk management and market positioning. Now, for segments to be truly useful in selecting the right target market, they need to meet what we call the criteria of effective segmentation. Essentially, this means that the segments should be meaningful and practical for our marketing efforts. One important aspect is identifying the optimal number of segments. Too few, and we might miss out on opportunities. Too many, and our resources could be stretched too thin. Beyond a certain point, adding more segments might actually hurt overall profits, so finding that sweet spot is key. To help define these potentially profitable market segments, we can apply several criteria. First, the segment should be large or profitable enough to justify our investment. It should be the largest homogeneous group, meaning members are similar enough that we can target them effectively. At the same time, the segment needs to be sufficiently heterogeneous, meaning it should differ from other segments, allowing us to tailor our strategies more precisely. Measurability is also crucial. We need to be able to identify and quantify the segment reliably. Stability over time is another key factor. Markets can change, so our chosen segments should be relatively stable to ensure our efforts remain relevant. Lastly, the variables we use for segmentation must provide clear direction, guiding our marketing decisions effectively. In summary, these segmentation criteria serve as a framework to help us identify the most promising, sustainable, and profitable market segments, aligning perfectly with our overall goal of finding the best target markets for our offerings. When we're looking at segmentation, one of the key criteria is that the segment should be large or profitable enough to justify the investment. This means that we need to consider whether the potential returns from serving this segment, whether through product development, marketing, or promotion, are worth the effort and expense. It's not just about size, but also about profitability. If a segment is small but highly profitable, it can still be a worthwhile focus. Conversely, a very large segment that isn't profitable might not be worth pursuing. Another important point is that the segment should ideally be the largest homogeneous group worth pursuing with a tailored marketing program. For example, high net worth individuals, or HNWIs, often form such a group. They share common characteristics and needs, which allows us to craft marketing strategies specifically aimed at them, making our efforts more efficient and impactful. So, in essence, when choosing segments, we want to focus on groups that are either large or profitable enough, and that are also homogeneous enough to tailor our marketing efforts effectively. This ensures our resources are directed where they can generate the most value, aligning with our overall goal of strategic and targeted marketing. Let's start with the first key point. Segmentation must be sufficiently heterogeneous, or in other words, different, compared to other markets. This means that the customers within this segment should respond differently to certain aspects of our marketing strategy. If they don't, then segmenting might not serve its purpose at all, because we're not really tailoring our approach to meet their unique needs. Now, moving on to the second point, the segment characteristics should be measurable. This is crucial because we need to be able to quantify aspects like the size of the segment and its purchasing power. By doing this, we can accurately assess the potential of each segment and decide where to focus our efforts. Together, these criteria ensure that our segmentation is both meaningful and actionable. They help us identify distinct groups that respond differently to marketing, and they give us the data we need to make informed decisions. This approach ultimately ties back to our overall goal of creating targeted, effective marketing strategies that truly resonate with specific customer groups. Now, let's talk about segmentation criteria, starting with adequate stability over time. It's really important that the segments we identify remain relatively stable so that our marketing efforts can have enough time to work effectively. If the segments keep changing too quickly, it becomes difficult to develop strategies that truly resonate with them and see the desired response. Next, the variables we choose to segment the market must also provide clear direction. In other words, they should help us understand not just who our target segments are, but also how to reach them effectively. This way, we can tailor our marketing efforts to serve these segments in the most efficient and impactful way possible. Connecting these points to our overall theme, maintaining stability and having clear, actionable variables are key to creating sustainable and targeted marketing strategies that truly connect with our audience over time. Now, once the bank has identified different market segments, the next step is to evaluate these segments carefully. They look at several key factors before making a decision on which segment to target. First, they consider the segment size, basically, how big is the potential market. A larger segment might offer more opportunities, but it also depends on other factors. Next, they assess the growth potential. Is this segment growing rapidly, or is it stagnant? A high-growth segment could provide more long-term benefits. Then, they look at the structural attractiveness. This involves analyzing how competitive the segment is, the barriers to entry, and other structural factors that could influence success. Finally, they align these insights with their own objectives and resources. Does targeting this segment fit with their strategic goals? Do they have the right capabilities and resources to serve this segment effectively? This process ensures that the bank chooses the most promising target segment, one that aligns with their overall strategy and maximizes their chances of success in the market. Now, let's look at the three main market coverage options that businesses typically consider. First, there's the undifferentiated approach, which means offering a single product or service to the entire market. This can be efficient but might not meet the specific needs of different customer groups. Next is the differentiated approach, where companies develop tailored offers for different segments. This allows for more personalized marketing and product development, helping to better satisfy distinct customer needs and preferences. Finally, we have the concentrated strategy, which focuses on serving a specific niche or specialized segment. This approach can be very effective when a company wants to become a leader or expert within a particular market segment. Understanding these options is crucial because choosing the right coverage strategy aligns directly with your overall marketing and business goals. It helps you allocate resources wisely and target your efforts where they'll have the most impact. Today, I want to talk about a strategy where a company targets the entire market with just one product. This approach focuses on common needs across a broad customer base, meaning we're not tailoring our product to specific segments, but instead emphasizing what most customers share in terms of basic requirements. By doing this, we can achieve cost economies through standardization. When we produce one main version of a product, our manufacturing processes become more efficient, and we can often reduce costs significantly. This also means there's less need for extensive customization, since we're not trying to meet every unique need with a different version. This strategy works best for simple products or those with low levels of differentiation. Think of everyday items that don't require complex features or personalized options. Overall, this is called undifferentiated marketing, where the goal is to serve the entire market with a single, standardized product. It's a powerful approach when the market's needs are fairly uniform and when efficiency and cost savings are top priorities. All right, let's talk about different offers for different segments. The idea here is to focus on varied consumer needs. By tailoring our products or services to specific segments, we can better meet what different groups are looking for. This approach often leads to increased repeat purchases because customers feel that the offering truly resonates with them. It also results in a stronger product-market fit, meaning our offerings align more closely with customer desires. However, it's important to keep in mind that this strategy requires more resources to manage effectively. Customizing offers for different segments can be resource-intensive, but the payoff is a more targeted and competitive marketing approach. This is what we call differentiated marketing, and it's a key way to better serve diverse customer bases while strengthening our overall market position. Let's talk about focusing all resources on one specific segment. This approach is particularly well-suited for smaller banks who may not have the extensive resources of larger institutions. By concentrating on a niche, these banks can actually achieve a high share within that particular segment. It's a strategy that's especially useful when resources are limited, allowing you to make the most of what you have. Another key benefit is that this focused approach often helps build deep, meaningful relationships with your customers. When you specialize and tailor your offerings, customers tend to feel more understood and valued. This strategy is called concentrated marketing or niche marketing. It's all about honing in on a specific group and becoming the go-to provider for them. Overall, it's a smart way for smaller banks to differentiate themselves and create a strong presence in a targeted market. Let's talk about the feelings of anxiety that often come up when people are faced with important decisions. It's completely normal to feel a bit uneasy in these moments. Now, this is where well-chosen and carefully executed messages come into play. They can really help reassure customers that they are making sound judgments, especially when they choose to maintain a relationship with your company. Using targeted marketing communications programs, you can reinforce the idea that sticking with your brand is the wise choice, even when competitors are making overtures. This helps customers feel confident and reassured about their decision to stay loyal. This ties into the concept of cognitive dissonance, where people experience discomfort when their actions don't perfectly align with their beliefs or desires. By addressing these feelings through reassurance and positive messaging, you can help reduce that dissonance and strengthen your customer relationships. So, in essence, managing these emotional responses and reinforcing the value of staying loyal is a crucial part of effective marketing strategy. When we talk about consumer banking, we're referring to the provision of financial services specifically tailored for individuals. The customer base in this area mainly consists of people from all walks of life, which means it's quite diverse. Some common examples include education loans to help students finance their studies, housing loans for purchasing or renovating homes, and lifestyle loans for personal expenses or investments. We also have club membership loans, which are often used for joining exclusive clubs, and margin financing on stocks, allowing investors to borrow funds to buy more shares. These services are usually advertised and promoted through various channels, especially in the newsprint media and on bank websites. The goal is to reach a broad audience and make these financial products accessible and appealing. Overall, consumer banking plays a crucial role in supporting individuals' financial needs, helping them achieve their personal goals and improve their quality of life. It's a vital part of the banking industry, connecting financial services directly to the everyday lives of people. So there are three main reasons why banks are now entering this market sector. First, banks have realized that economic development has led to the emergence of a growing middle class. This middle class has strong purchasing power and a certain level of affluence, which makes them an attractive target for banking services. Secondly, banks are experiencing shrinking profit margins in their corporate banking segments. This means that traditional corporate banking isn't providing the same level of profitability it once did, prompting banks to look for new avenues to grow their earnings. And third, consumer banking offers a steady source of funds for banks. It provides consistent revenue streams and helps diversify their income sources, making their overall business more resilient. So, putting it all together, the increased middle class, the need to offset shrinking corporate profits, and the stable income from consumer banking are key drivers behind this sudden interest. It all ties back to the broader theme of banks adapting to changing economic landscapes and seeking new growth opportunities. In the past, customers could only withdraw cash over the counter at bank branches. It was a time when visiting the bank was the only option for many banking needs. But as technology evolved, so did the way we access our banking services. Now, we have ATMs, which allow us to withdraw cash quickly and conveniently without needing to go inside the bank. Beyond ATMs, internet banking has transformed the experience, enabling us to manage accounts, transfer funds, and pay bills from our computers. Moving further, mobile banking apps put all these features right into our smartphones, making banking even more accessible on the go. E-money and digital banking have introduced entirely new ways to handle money digitally, reducing the need for physical cash altogether. Open banking APIs are another groundbreaking development, allowing third-party providers to securely access banking data and services, fostering innovation and more personalized experiences. All of these advancements exemplify how technology has become integral to consumer banking, making it more convenient, faster, and more tailored to our individual needs. This shift underscores the overall theme of how digital transformation continues to reshape our financial lives. Let's talk about the role of technology in consumer banking. As we move forward, we see a new generation of skilled and knowledge-based employees being stationed directly in the branches. Their main role is to answer customer inquiries effectively and provide personalized support. This shift emphasizes the importance of having knowledgeable staff who can cater to specific customer needs. Additionally, banks are upgrading the appearance of their banking halls. This isn't just about aesthetics, it's about meeting evolving customer expectations. A modern, inviting environment helps foster an atmosphere of trust and confidence, which is crucial for building long-term relationships. It's also important to understand that, according to McCoy and colleagues in 1994, consumers' choice of distribution channel depends heavily on their market segment and geographic location. This means that what works for one group or in one area might not be suitable for another. Therefore, before banks make significant investments in developing new delivery systems, they need to thoroughly understand their existing customers' wants and preferences. Knowing your customer base is key to designing effective, targeted channels that truly meet their needs. This understanding helps ensure investments are strategic and aligned with customer expectations, ultimately supporting the overall goal of delivering better banking experiences. Let's talk about technology in consumer banking. Customers today are demanding more convenience, more flexibility, and easier access to their banking services. As lifestyles and spending habits evolve, there's a clear need for more suitable distribution channels, whether that's through digital platforms or mobile apps. As consumers become more computer literate, they also expect faster delivery of products and services. Speed is now a key factor in customer satisfaction. At the same time, banks are under pressure to meet strict capital adequacy requirements, known as CAR, which means they need to be more efficient in how they allocate their funds. This drive for efficiency makes consumer banking especially attractive because it offers high interest margins and fee-based income streams. Overall, this combination of technological advancement, changing customer expectations, and regulatory demands is shaping a very dynamic and profitable landscape for consumer banking. Topic 5 Part II, Financial Services Customers. In this part of the presentation, I want to focus on the unique aspects of financial services customers and why understanding their needs is so crucial. Financial services customers are a diverse group, ranging from individual consumers to large corporate clients. Their expectations often include security, transparency, and personalized service. It's important to recognize that their trust is foundational, since financial transactions involve sensitive information and significant resources. As we connect this to the overall theme, remember that delivering tailored, secure, and efficient solutions helps build long-term loyalty in this industry. Understanding these key points allows us to better serve our clients and stay ahead in a competitive landscape. At the end of this session, the student will be aware of the importance of integrating consumer behavior into marketing strategies. We'll explore how understanding customer behavior is crucial for developing effective marketing plans. Next, you'll learn to evaluate customer behavior theories, both in B2C and B2B contexts, especially within financial services. It's essential to consider how theories of customer satisfaction, dissatisfaction, inertia, loyalty, switching, word of mouth, risk, and trust influence marketing decisions in the financial sector. Finally, you'll develop arguments for strategies that are built around customer behavior, focusing on the demand side of financial services marketing. These insights will help you craft more targeted and customer-centric marketing approaches, aligning strategies with actual customer motivations and behaviors. Now, let's explore the perspectives of consumer decision-making. First, we have risk and involvement, which are crucial because they influence how much effort and thought a consumer puts into a purchase. Higher risk or involvement typically means more careful evaluation. Next, satisfaction and dissatisfaction play a vital role in shaping future behaviors. A satisfied customer is more likely to return, while dissatisfaction can lead to negative word of mouth. Speaking of which, customer loyalty and word of mouth are interconnected. Loyal customers often become brand advocates, sharing their positive experiences with others. Trust is another fundamental element. It underpins all these aspects and determines whether consumers feel confident in their choices. Moving on, business behavior significantly impacts consumer perceptions, influencing their decision-making process. We also have decision-making units, which refer to the individuals or groups involved in making a purchase, highlighting that choices are often collective rather than individual. Relationships and power dynamics come into play here, affecting how decisions are negotiated and who ultimately has influence. Finally, this session structure helps us understand that these concepts are interconnected, forming a comprehensive view of how consumers make decisions and how businesses can better engage with them throughout this process. Understanding who our financial services customers are is absolutely central to sustainable marketing. Whether they are personal consumers or business clients, knowing their needs and behaviors helps us tailor our approach effectively. Different perspectives on consumer decision-making are crucial here. People don't make financial choices in the same way, so we need to consider various factors that influence their decisions. Understanding consumer behavior is the only way we can effectively address challenging issues like trust, risk, and loyalty, especially in financial services where these elements are so vital. And interestingly, the current credit crunch might actually be an opportunity for financial institutions to rethink their marketing strategies. Instead of sticking to traditional methods, we can adopt a more customer-based perspective that truly puts their needs first. Ultimately, how consumers engage with financial services is a key aspect of this whole discussion. By understanding their experiences and expectations, we can build stronger, more trusting relationships that support sustainable growth. Consumer behavior is a fundamental area of study in marketing, and it's explored through various approaches. For example, we often look at it from a rational perspective, where consumers make logical, well-thought-out decisions. But we also recognize the experiential approach, which considers the more emotional, less rational influences on behavior. When it comes to financial services, things can get a bit tricky. These services are often complex and not always straightforward to understand, so consumers might not always act in a purely rational way. That's where the experiential model becomes particularly useful, as it helps us acknowledge and better understand those less rational, more emotional aspects of consumer behavior. Specifically, in B2C contexts, business to consumer, these insights are especially relevant. Understanding that consumers don't always act purely logically allows us to tailor our marketing strategies to better connect with their feelings and perceptions. So, in sum, recognizing the different approaches to studying consumer behavior, including the experiential model, helps us create more effective marketing, particularly in complex areas like financial services, by aligning with the real, often emotional, ways consumers make decisions. Let's walk through the rational model of consumer decision-making by looking at a typical scenario. First, we have the need recognition stage. Imagine your car fails its MOT so badly that the repair bills actually exceed what the car is worth. On top of that, you realize you don't have enough money to replace it. That's what triggers the decision process. Next, we move to the search stage. You start checking different options. You look at bank loan rates, ask your parents for advice, note supermarket loan rates while you're shopping, and even ask friends or classmates if they know about good loan opportunities. This stage is all about gathering options and information. Then comes pre-purchase evaluation. Here, you've got three choices. You could take an existing bank loan, but the rate isn't particularly attractive. Or you might consider a supermarket loan with a better rate, although borrowing from a supermarket feels a bit unusual. Lastly, you might ask your parents for a loan, but that comes with its own strings attached, plus you want to show some independence. Moving to the purchase or consumption stage, you decide to go with the supermarket loan because it offers the best rate. You sign the agreement and set up repayment arrangements, feeling confident about your choice. Finally, the post-purchase evaluation. You think you got a good deal when chatting with colleagues and seeing ads from competing loan providers. However, when it comes to the car, the story might be different. This raises an interesting question. How connected are these two purchases? Are you just evaluating the loan on its own, or are you also considering the overall outcome, like the car situation? This entire process illustrates how consumers rationally evaluate their options at each stage, making decisions based on the information they gather and the trade-offs they consider. Let's talk about how the intangibility and complexity of financial services can increase the perceived level of risk. Because these services are intangible, meaning you can't see or touch them before purchasing, it becomes harder to evaluate their quality up front. This is further complicated by their complexity, which can make understanding and comparing different options quite challenging. In addition, since search qualities, things like reviews or tangible features, aren't readily available for financial services, consumers often have to rely on experience or credence qualities. That is, they depend on their past experiences or trust in the provider to make decisions. Now, involving yourself in financial decisions can vary quite a bit. Involvement refers to how much effort or thought a customer puts into processing information for a purchase. For example, when you're making an investment, that usually involves a high level of involvement because it's a significant financial commitment and requires careful consideration. On the other hand, using a cash machine is typically a low-involvement activity, quick and straightforward. Interestingly, research shows that a lack of involvement is quite common among UK consumers of financial services. Many tend to make quick decisions or rely on routine rather than deep engagement. So, when we think about risk and involvement together, it's clear that the level of perceived risk can influence how involved a customer becomes. The more uncertain or risky they perceive a service to be, the more effort they might put into understanding it. Conversely, low involvement often means less effort, which can sometimes lead to less informed decisions. This dynamic is crucial to understanding consumer behavior in financial services and how we, as providers, can build trust and simplify decision-making. Let's take a closer look at this table adapted from Stuart Menteth and colleagues in 2006, which really helps us understand the interplay between consumer attributes, their desired experiences, and the implications for financial services. First, we see that consumers can have quite different characteristics. For example, some might be cynical, which means they value integrity and honesty. For these customers, building a strong corporate image and demonstrating sustainable and ethical practices is key. Then there are the knowledgeable consumers. They're seeking meaningfulness in their interactions. To satisfy them, products and services need to fit seamlessly into their lifestyle and needs, providing real value and relevance. Next, we have the time-poor segment. These consumers want relevance. They need services that are quick, efficient, and directly aligned with their immediate needs. This directly influences how we develop our products, making them more streamlined. We also encounter tribal consumers who seek validation from their tribes or segments. This suggests that understanding social groups, segments, or even variables and interactions within these groups can help tailor offerings that resonate on a tribal level. For those who are more individualistic, customization is crucial. They want experiences that are personalized, tailored specifically to them, making the service feel unique and relevant to their personal identity. Demanding consumers are those with high expectations for excellence. Recognizing that one size doesn't fit all here is vital. Offering personalized, high-quality service can meet their elevated standards. And finally, experience-seeking consumers crave participation. They want to be actively involved in their service experience, which means engaging them in ways that acknowledge their desire for interaction and involvement. Overall, this experiential view of consumer behavior emphasizes that understanding these diverse attributes allows us to design more meaningful, relevant, and engaging financial services. It helps us recognize that a tailored, consumer-centric approach is essential to meet the varied expectations in today's market. Satisfaction is essentially the gap between what customers expect and what they actually perceive. When their perceptions meet or exceed expectations, they tend to feel satisfied. This feeling of satisfaction can be a powerful driver for building loyalty, encouraging repeat business, and positive word of mouth. On the other hand, dissatisfaction arises when perceptions fall short of expectations, and it can stem from various causes, be it product issues, service failures, or unmet needs. To improve customer experience, it's important to identify and remove dissatisfiers, those pain points that frustrate customers, and also to enhance satisfiers, features or aspects that delight them. By doing so, we not only improve customer satisfaction, but also influence their share of wallet, meaning they're more likely to spend more with us, and they're more inclined to recommend us through word of mouth. Understanding the difference between satisfaction and dissatisfaction helps us focus our efforts on what truly matters, closing the gap between expectations and perceptions, and thus fostering long-term loyalty and growth. Customers seek to achieve a goal, and satisfaction with the service is a key measure of whether they've reached that goal. When customers are satisfied, it not only indicates they're happy with the service, but also influences several important outcomes. First, let's talk about loyalty. The role of satisfaction in building customer loyalty is actually stronger than any costs they might consider when switching to a competitor. This means that if we want to keep our customers, we need to focus on delivering high levels of satisfaction, because that loyalty is what really keeps them coming back. Next, there's the share of wallet. Customers who are satisfied are more likely to buy additional services from us. For example, a satisfied banking customer might also purchase a mortgage, insurance, or investment products. They're more open to expanding their relationship with us. Then there's word of mouth. Customers tend to tell friends, family, and colleagues about their banking experience more than with other types of services. Word of mouth is incredibly powerful because it's a low-cost, highly credible way to attract new customers. Happy customers can become our best advocates. Now, it's important to understand that dissatisfaction isn't simply the opposite of satisfaction. They often come from different sources. So, addressing dissatisfaction isn't just about doing the opposite of what makes customers satisfied. Instead, we need to focus on eliminating dissatisfiers, those factors that frustrate or disappoint our customers, and also work on enhancing the satospheres that make their experience positive. If customers are dissatisfied, they might stay with us, but they're less likely to increase their share of wallet. In other words, dissatisfaction can keep their loyalty intact, but it hampers growth in their relationship with us. So, in summary, understanding both satisfaction and dissatisfaction helps us create better strategies. We aim for high satisfaction to foster loyalty, increase share of wallet, and generate positive word of mouth, all of which are crucial for our overall success. Loyalty actually combines two important aspects: attitude and behavior. When we talk about attitude, we're referring to the customer's favorable feelings towards a brand or product. This is about how they feel deep down, positive emotions, trust, and a sense of connection. On the other hand, behavioral loyalty is demonstrated through repeat purchases. It's the actual actions customers take, consistently choosing your brand over competitors. It's important to note that many customers may show behavioral loyalty only, meaning they keep buying without necessarily feeling strongly about the brand. They might be loyal out of convenience or habit, rather than genuine preference. Also, while satisfaction is definitely necessary, customers need to be satisfied to stay loyal. It's not enough on its own. Satisfaction alone doesn't guarantee loyalty. The emotional connection and consistent behavior are equally crucial. Understanding customer loyalty means recognizing that it's a blend of how customers feel and how they act. Both elements play a role in creating true loyalty, which is essential for long-term success and building a solid relationship with your customers. Loyalty is often seen as a mix of attitude and behavior. What does that mean in practice? Well, customers need to have a positive or favorable attitude towards the financial institution, or FI. They should feel good about it, trust it, and believe in its value. But attitude alone isn't enough. Customers also need to demonstrate repeat purchase behavior, meaning they keep coming back and doing business with the FI over time. Now, here's an important point. Without that favorable attitude, switching to another FI is quite easy for customers. If they don't feel connected or satisfied, they're more likely to look elsewhere. Interestingly, many customers might be loyal in their actions. They keep using the same FI, yet their loyalty might be purely behavioral. They might do so out of habit or convenience, not because they really feel a strong emotional connection. It's also worth noting that customer satisfaction is a key factor in fostering loyalty. But satisfaction alone doesn't guarantee loyalty. You can be satisfied with a service, but still choose to switch if better options come along or if your needs change. So, loyalty is a more complex, multi-dimensional concept. It's not just about being happy with the service. It's about developing a genuine, sustained relationship that combines attitude and consistent behavior. This is central to understanding how to build long-term customer relationships in the financial industry. Let's explore how loyalty isn't just a simple concept, but actually varies depending on two key factors: attitude and repeat behavior. When we talk about true loyalty, we're referring to customers who not only have a high positive attitude towards our brand, but also demonstrate consistent repeat behavior. These are the customers we want to nurture because they genuinely believe in us and keep coming back. On the other hand, we have latent loyalty. These customers show a good attitude, they think positively about us, but they don't necessarily repeat their behavior frequently. They're interested and engaged, but perhaps they just need the right incentive or reminder to become more consistent. Then there's spurious loyalty. This is a tricky one because these customers repeat their behavior, but their attitude isn't necessarily positive. They might stick around out of convenience or lack of alternatives, but their underlying feelings aren't truly loyal. It's important to recognize this so we don't mistake mere repetition for real loyalty. And finally, no loyalty. These are customers who exhibit low attitude and low repeat behavior. They're not particularly engaged or committed, and they're unlikely to stick around unless we find ways to change their perception or experience. Now, to better understand these different types of loyalty, we can apply the Dick and Basu loyalty matrix, which is a useful tool, especially in banking, where understanding customer loyalty is critical. It helps us see where each customer falls and tailor our strategies accordingly. Recognizing these nuances allows us to focus our efforts more effectively, strengthening true loyalty while addressing the gaps with those in other categories. Let's take a closer look at the different types of customer loyalty in financial services, as adapted from Dick and Basu's model. First, we have the category of no loyalty. These customers have a high likelihood of switching to another provider, but their switching is often restricted by high switching costs. Interestingly, they may be inert, meaning they don't actively seek change, but can also be vocal critics of the financial institution if they do decide to leave. Next is spurious loyalty. Here, customers might seem loyal because they stay with a provider, but it's really just inertia or a perceived convenience. They're actually quite susceptible to price changes or better offers from competitors, making their loyalty quite fragile. Then there's latent loyalty. These customers have occasional contact with their current financial institution and might not be fully committed. However, they are open to cross-selling opportunities, which means with the right approach, they could become more loyal. Finally, at the highest end of loyalty, we have genuine loyalty. These customers maintain a long-term relationship with multiple products from the same provider and often act as advocates for the FI. They are not just repeat customers, they actively promote the institution to others. What ties all these categories together is the concept of relative attitude and repeat behavior. The slide shows how loyalty can vary greatly depending on these factors. Understanding these different loyalty levels helps us better tailor our strategies to retain customers and foster genuine loyalty, which is essential for long-term success in financial services. Businesses behave differently from consumers, and that's a crucial point to understand as we look at B2B behavior in financial services. Often, businesses are more informed and demanding compared to individual consumers. They do their homework, compare options carefully, and expect a higher level of service and expertise. Decision-making in businesses usually involves multiple roles within the decision-making units. So, instead of just one person making a choice, there could be several stakeholders, finance, operations, management, all playing a part. This makes understanding their needs and priorities more complex, but also more important. Relationships and power dynamics also play a significant role. Building strong, trust-based relationships can influence the decision-making process and outcomes. Power within these relationships can determine who has the final say or influences the process most. It's also worth noting that small businesses can sometimes behave quite like personal consumers. They might be more impulsive or less formal in their decision-making, especially if they're just starting out or are very close to the owner. Overall, recognizing these differences helps us better tailor financial services to meet the specific needs of business clients, making our approaches more effective and relevant. Now, let's look at how businesses are evolving in their understanding of financial services. It's expected that they will become more informed and savvy about the options available to them. However, when it comes to small businesses, they often resemble personal customers more than larger organizations. This means they might not have the same level of financial sophistication or experience in dealing with financial institutions. Building strong relationships is crucial here, but it doesn't happen overnight. It takes time to develop trust and understanding between financial institutions and businesses. There's also an important perception we need to address. Many believe that financial institutions tend to lend to startup companies, but they expect quick returns on those investments. The reality is that banks and other financial providers have responsibilities to their other stakeholders as well, which means they have to manage their lending carefully and prudently. Another key point is about power dynamics in B2B relationships. Often, the power leans more towards the company than the financial institution, especially as the company grows larger. The bigger the company, the more influence it tends to have in negotiations and decision-making processes. All of these factors influence business behavior and how companies interact with financial services. Understanding these dynamics helps us see the bigger picture of how financial relationships are formed and maintained in the business world. Now, let's talk about the various roles that influence B2B buying decisions. First, there's the initiator. This is the person who recognizes that there's a need for a product or service. They're the ones who kick off the process by identifying a problem or opportunity. Next, we have the influencer. This individual shapes opinions and helps sway the decision by providing insights or expertise. Their role is crucial because they help guide the decision makers towards the best options. Then, there's the gatekeeper. This person controls access to information or key decision makers, effectively managing who gets to be involved in the process and what information is considered. Finally, we have the buyer and the decision maker. These are the individuals who typically make the final choice and complete the purchase. In small businesses, these decision-making units can be quite streamlined, often involving just a few people, but each role remains important. Recognizing these roles helps us understand how decisions are made and how we can better engage with the different influencers throughout the process. This understanding is key as we look to tailor our approaches to different decision-making dynamics. In this slide, we're looking at decision-making in a small business when it comes to securing an expansion loan. The key role here is the decision-maker, which in this case is the initiator. This is the person who ultimately makes the call on which provider to go with. Then we have the buyers. These are the business partners who both sign the loan agreement with the selected provider, making the process official and binding. We also see the gatekeeper, another business partner, who plays a crucial role by restricting the options available for selection. This person controls or filters the choices, ensuring that only certain providers are considered. Next is the influencer, an outside colleague with whom the partners play tennis, for example, who speaks positively about her experience with a certain loan provider. Her opinion can sway the decision, even if she's not directly involved in the formal process. And finally, the initiator is the one who recognizes the need for an expansion loan, typically to purchase more equipment or grow the business. Understanding how these roles interact helps us see the complexity of decision-making in small businesses. It's not just about choosing a provider. It's about navigating various influences and restrictions that shape the final decision. This overall process is essential for understanding how small businesses make strategic financial choices. Experience really shapes how customers evaluate services. It's not just about the product or the price, but the entire experience they have with your brand. Attributes like quality, friendliness, and convenience all influence the kind of experience customers desire. Building integrity and trust is crucial, and that comes through consistent actions, showing customers you deliver what you promise. It's also important to recognize that different consumers have different expectations. Some may value speed, others personalization, and some might prioritize reliability. That's why we need to tailor experiences for different tribes or customer segments. Understanding their unique needs allows us to create more meaningful and memorable interactions. Overall, this experiential view of consumer behavior reminds us that experiences are at the heart of customer evaluation. When we focus on these aspects, we can foster stronger relationships and loyalty. In this final slide, I want to bring together the main ideas we've explored about the customer in financial services, whether you're dealing with consumers directly or other businesses. Customers often use rational decision-making models when choosing financial products and services, and decision-making units, those groups or individuals involved, can play a significant role in that process. At the same time, there's an experiential approach, especially highlighted by postmodern marketing theories, which suggests that customer decisions are also driven by emotions, perceptions, and personal experiences. It's really important to understand that satisfaction and dissatisfaction aren't simply opposites, they are distinct states. Financial institutions need to know how to truly satisfy their customers, and, equally important, how to identify and eliminate causes of dissatisfaction. That's key to building trust and loyalty. Speaking of loyalty, it operates on both attitudinal and behavioral levels. Some customers may have a positive attitude but remain inert, meaning they don't actively engage or switch providers easily. So, fostering genuine loyalty requires more than just good service. It's about emotional connection and consistent experience. Finally, while customer behavior in financial services tends to become more informed over time, small businesses often require special attention. They have unique needs and challenges, and recognizing that is crucial for building strong, tailored relationships. To sum up, understanding these dynamics helps us better serve our customers, build loyalty, and adapt our strategies to different customer segments, aligning with the overall goal of delivering value and fostering long-term relationships.